Today I'm joined by Jodie Gunzberg, Director Commodities at S&P Indices. We will be looking carefully at some of the key concepts around the S&P GSCI Commodity Indices and how the S&P GSCI suite of indices can be used by market participants. Jodie, can you please explain how the S&P GSCI represents commodities as an asset class?
Sure. The S&P GSCI is an index that we would consider to be really a pure beta of the asset class because it represents the way that the world looks. So the way that it does this is through its production weight. And how you can think about that would be if you believe that the S&P 500 or the S&P ASX 200 is market capitalization weighted for equities, and that represents the stock market space, then the production weighted is analogous for the commodities. So again, you'll get, heavier energy, for example, than agriculture because that's the way that the world looks.
There are also other ways to get exposure to commodities through equities or direct investing. Can you give us some insight on the challenge to investing directly and also how investors might benefit from using commodity futures with equities?
There's a couple of different ways to get exposures to commodities, and one, of course, would be directly investing, but that's pretty challenging for most investors because storage is difficult and costly. And for example, if you were to go buy live cattle, where would you put 40,000 pounds of live cattle? For most, that's pretty impractical. So equities tends to be an easier answer. And the benefits of that are that some futures markets are underdeveloped, as in timber or coal or water or steel. And if an investor wants exposure to those types of commodities, equities may be the way to go, except for the issue with equities is that there's management decisions that are made for shareholder value. And those decisions may have really nothing to do with the underlying commodity. So the correlations of the producer commodity stocks can be less correlated to the underlying commodities due to the management decisions and stock market beta embedded in them. Futures are really the most practical and direct way for investors to get commodity exposure because the futures prices are directly related to the future expected spot prices in the market, and that's just driven by supply and demand, which is, of course, what drives the commodities market. So investors find that using futures gives them the liquidity and the direct exposure that they need in order to add commodities into their portfolios.
While it's well understood that commodities have low correlations to stocks and bonds over the long run, many investors are unaware of the drivers behind this. Please explain what causes the difference in return patterns and why sometimes it is not enough to deter spiking correlations.
While in the long run, commodities have historically had returns and risks similar to that of equities, the patterns of returns can be very different. And much of this is driven by shocks that are unique to commodities. So on the supply side, something like a pipeline burst or a drought may cause commodities to spike, whereas they have nothing to do with the stock market. And what this does, again, is it really drives correlations down in between equities and commodities. However, there are certain times where the correlations rise. Currently, we're in an environment where there's relatively high correlations between stocks and commodities. And this has happened before in history. And it happens when aggregate demand drops dramatically. So if you were to look back in the 1980s or after 2001 and the tech bubble burst, you would have seen correlations spike back then too. But both of those times, the correlations have come back down to the normal lows. And if you think that this time is like history, then you would expect correlations to drop again.
Jodie, thanks for joining me today.
Thank you.